What's up again, guys? This is Mike Sharp. This is Sharp Investing. Thanks for coming back to the channel. This is about StoneCo Quarter 2. I'm a bit late here and I apologize. And I also apologize for the sound and the video quality here. I have no lighting. I'm in a hotel room and this is the last in my hotel room series. Okay, so Quarter 2 for StoneCo. Another phenomenal quarter. They just continue to roll, and I'll just go through some of the details here. It's almost all positive. So revenue is up year over year, 28% to about 3 billion. Okay, so the growth rate's coming down. That might be the only negative thing here. We can see that the growth rate's coming down over time. This is expected, though. We might end up at a 20% run rate next year. But the great thing is that their incremental margins are so huge that they can still produce massive profit growth, even if they grow at 15 or 20%. So that's the foundation of my thesis here. As we can see, if we go to the margins, the EBT margin, so that's pre-tax margin, is up almost 50% from last quarter. And now they are running at a 15.1% pre-tax margin. And this is just really fast growth in terms of how fast their margins are expanding. So the thesis is playing out. And if you annualize that rate, that earnings rate, let's say the growth completely stopped, but they stayed here, they would produce about 320 million in pre-tax profit over a year, which means the stock is now trading at 10 times or so of annualized pre-tax earnings, which is very cheap for a company that is growing profits this quickly. So I would say that I'm going to continue to add to this. My strategy here is if the price comes down, I will buy more to maintain a certain percentage. So as it comes down, I'm going to maintain about 30% in my portfolio at the bottom. And then as it goes up, I will not sell it. So I can add a little bit here below $11. I haven't done that yet, but I'm planning on doing that. But yeah, that's my strategy so far. If they keep continuing to smash these home runs, I'm happy to buy more and maintain. So remember, price down is actually good. If you're a value investor, price down, that's what we want, because we can buy buy great companies on sale. We don't want it to go up right away. We want to be able to accumulate. So the overall earnings, let's say after tax or even pre-tax, they're up sixfold from last year. Now that's not that relevant because they were coming out of a negative earnings period due to the credit problem they had. But every other metric looks really good. Customers are still growing fast. They've added 200K in the quarter. That is, if you look at PagSeguro, they're doing a lot better in this area than Pags. So that's one of their main competitors. Mercado Libre is another main competitor, but I think they're actually the one to watch out for. So we've got to keep an eye on Melly. They moved a little bit of depreciation into earnings by capitalizing the expenses. So it was quite small, but that's worth watching. And then the lazy investor pointed that out. So thanks again, Lazy, for pointing that out. But that is, if those numbers get big, that's concerning because it's a way to manipulate earnings. But right now it's not a material size. We'll keep an eye on that. That might just be because they've changed the CFO and the CFO had different ideas, because accounting is not always black and white. There's room to maneuver within the GAAP rules, and both would be correct, right? If you're doing, there's not just one way to account for a lot of things. So costs, again, if we look at the cost side, this is the key to the whole thing from my perspective. I've got to find it on the sheet here, but the main cost of delivering the product, so cost of service, administration expenses, and selling expenses, these were, as a group, mostly flat from quarter one. So that shows you they've added a whole bunch of revenue. They've added 240 million in revenue, and these costs haven't moved, right? So that's the huge margin we're talking. That's the incremental margin we're talking about here. They can add revenue, and it doesn't cost them anything. Now, on the other side, the financial expenses did unexpectedly go up fairly significantly. So those are up by 150 million. And the management said that that was due to a decision to hold more cash on the balance sheet than previously. And so that is they said it's a one-off move to sort of realign things. And that, again, probably due to new management making those decisions. But on the other side of that one, the central bank has started to reduce interest rates, right? So we were forecasting that they would probably do that, and that would end up bringing down the financial expenses. So we might see that start going in the other direction soon, assuming that the central bank continues to cut. Like if they just cut a little bit, it's probably not going to have a big impact. But if it goes from 13.75 to like 7% on the Selic rate, that's going to have an impact. And the last thing I would mention, I mentioned this in passing last time, I think, too, and the future of StoneCo is probably that they're going to turn into a bank. That would be my guess, that they're going to end up in banking is going to be a bigger chunk of their bigger chunk of the pie at some point, like in the distant future, right? So what happens is, eventually the growth by adding merchants is going to run out, right? There's only a limited number of merchants. It's pretty competitive space. So those growth rates will come down over time. But as they start adding banking products en masse to those customers, then you'll see the banking side income increase. Now, this hasn't started yet in a significant way, but the credit product that they're testing right now will be live at some point soon, unless they have a problem with it, unless the default rates go through the roof and they pull back on it. But part of my expectation was that once they get this product back, you'll see the margins increase even more because of the way that those are booked as revenue, and there's not a huge amount of expenses attached to credit revenue. So and that's why they were able to get 30+% margins prior to the previous credit product blowing up. So there is another potential leg up here, right, where they get really heavy into the banking side. Yeah, and I think what else on the counter side to the banking argument, they've had quite a few new customers come on recently, and the deposits went up pretty significantly. And a lot of that is due to their micro. They've added a banking product to their micro merchants, right? So a lot of them came on, but they have very small balances. So the average balance has come down, but the overall balance has gone up. But the thing is, when you have interest rates at 13, 14%, everyone saves their money in the accounts because they're getting paid such a good rate to hold cash. But as the central bank pulls down rates, you're going to see that those deposits come down as well, and so there's a headwind on that front. I'm not very worried about that because there'll still be customers, but the banking deposits will start to come down at some point here, I think, and that might look negative on some future earnings releases. So overall, this company is doing phenomenally. Everything's working well, I think, and as expected. And I'm happy to, like I said, add as the price comes down. And yeah, I'll do another video after the next earnings release, and hopefully it's kind of a nothing burger. They're just continuing to kick ass again. So I will catch you in that video or one in between. Thanks for watching.